A warm welcome to everybody listening into this call where we have the pleasure to present MPC Energy Solutions. To take us through the call today, we are joined by CFO and Interim CEO Stefan Meisner. You will help us through this presentation. It's your Q3 results that we will dig a little bit into. Should I come with the main headlines? I will start with the first one, that you actually are giving some new targets on being self-sustaining the next 12 months. But unfortunately, also some small delays are cutting into your guidance. So I think we will go through that also. As always, you are encouraged to ask questions. Do it during the presentation, do it after. But I think we will hold the presentation fully, and then we will take the questions in the end. As always, you can ask it in Danish or English. In Danish, I will try and translate it to the best of my ability. But I think for now, I will hand the call over to you, Stefan.
Thanks, Michael. I still haven't learned Danish, and I apologize for that in advance. Second apology I have is I have a little bit of a cold, so if I go on mute and cough a little, please forgive me for this. Otherwise, thank you for the time. Good morning to everyone joining today. When I last spoke to you, it was after we had a leadership change in the organization, and I'm very happy to report that we have taken the last few months to already make some strategic decisions for future adjustments. We also redefined our short-term priority and needs, and some of these decisions have already been taken. Others will be taken in the coming weeks. I'm more than happy to share that with you today. Before we look ahead, I'd like to look back at the quarter that we just had and the year-to-date results. On the most important projects and company news, we made an announcement that we would exit one of our combined heat and power projects in Puerto Rico. The project was in the early phase of construction. We've already invested some money, and then we took a contractually defined breaking point, if you will, to exit the project. Why did we do so? We believe that neither CHP nor Puerto Rico are part of our strategic focus down the road. CHP is not a renewable technology. Puerto Rico is a very challenging market, very close to the US, where financing is not so easy to get, and where we believe that other investors with a different risk-return profile can have greater impact. So we already invested 2.4 million in the project, which we will get back over the next 6 months, latest by March 2024, as part of our idea and initiative to shore up our cash reserves. Another important announcement is that unfortunately, our Colombian joint venture, Planeta Rica, it's a 50-50 joint venture, a solar PV plant that is being developed and constructed by our partner, Akuo, has seen further delays. While the plant's construction has been completed for some time now, and we've done the tests that we can without being connected to the grid, the substation is not yet ready. It's not in our scope, and we are working very hard to make sure the grid operator delivers that connection finally. The new projected date is by mid-November, so we will have to be a little bit more patient here. And that's also why this plant is not, as previously anticipated, contributing to our results year to date, because of the delay that we've seen in connecting it. And then an update on our partnership with Internet Global. It's a US microgrid developer that we have invested equity in. And we also had a strategic partnership that they would develop projects, and we had a right of first refusal to acquire these projects. We have terminated this agreement for the simple reason that most of the pipeline was focused on CHP, focused on Puerto Rico, which is no longer in our interest. And we also wanted to give Internet the opportunity to immediately reach out to other potential co-investors that they can speak to without being tied down by us. Our shareholding in Internet Global will not change. We believe the company has still a lot of upside. They have a strong pipeline, aside from the Caribbean, also in Africa and Australia. But we will simply no longer work together on new projects for the foreseeable future. Looking at the numbers, the positive is here that all the numbers that should be up are up compared to last year. This is because we, of course, commissioned 3 new plants this year, so we have a much bigger portfolio, a stronger operation capacity. So this increase is quite natural. But it was also, as we will see on the next slide, the strongest quarter we ever had in terms of revenue, project EBITDA, despite the challenges that we were facing. So if we look in the details, we generated nearly 75 gigawatt hours from our operating asset, corresponding to 6.9 million in revenues and 3.1 million in project EBITDA. If we take out our energy trading activities, which we had to do earlier this year in Colombia, we actually look at 6.3 million in revenues and 3.6 million in EBITDA, reflecting the trading losses that we incurred when we had to engage in the Colombian spot market. These trading losses are now contained, so going forward, the impact will no longer be visible. It will be reduced towards the end of this year, and it will be entirely eliminated next year when we start fresh, so to speak. We still remain well capitalized. The total asset base hasn't really changed compared to the previous quarter, so that we can take a look at the quarterly results themselves. And as you will see, as I mentioned before, it was the strongest quarter so far this year, which means it was the strongest quarter overall in our young company's history. This is in part because we commissioned additional plants to the grid. In the second quarter, late second quarter, we brought another Colombian asset online so that we saw output from that asset for the first time in Q3. And also we know that the seasonal pattern of our portfolio, which is predominantly solar PV, is also strongest in the third quarter of the year in the Northern Hemisphere. So that's what we're looking at. We look at the different projects individually. We will notice that our CHP plant in Puerto Rico has really shown underwhelming results compared to our own expectations. This is due to the fact that the off-taker is running a pharmaceutical production facility. This facility is being restructured and refurbished. And until it's completed, which is expected later this year, there is simply a lower energy demand. And that's why we're generating less revenue from this project, while at the same time looking at a fairly stable operating cost structure. So that's why the margin and the output from this project has been a bit below our expectations. Contrarily, our projects in El Salvador and Mexico are performing very well. In Mexico, we continue to make technical improvements, which kept the margin lower than what you would normally expect. We will see this being reversed in 2024. But overall, these two projects are delivering very good numbers. And they're also the main factors why we are today where we are today, because these two projects for the foreseeable future will play a very important role for our overall results. Los Girasoles, the Colombian project, I mentioned it, is now operational. The operation is going well, but the trading losses from the first half of the year are really putting a strain on the overall performance of the asset. Also something that we will not see again in 2024. And this is why it's, I think, more important to look ahead and think about the upsides that we will see. This year, we provided, or we just updated our outlook this morning that we should see between 9.5 million in revenue, 5 and 5.5 million in project EBITDA because of all the negative impacts that we saw this year, trading losses, underwhelming performance in Puerto Rico, the delay in Planeta Rica, and some ramp-up costs that you usually have during the first operational year. All of this will be gone in 2024. We will have 5 instead of 4 projects under operation. The Neo CHP project can return to its full capacity when the manufacturing side of the off-taker is refurbished. The PPA price for the Santa Rosa project in El Salvador, which is currently applying a discount because of the connection delay that we had when the project started operation, will be gone. PPA price will go up 20%. This will have an immediate impact on revenue and therefore profit. In Mexico, the technical improvements are completed so that the output can finally go where it belongs. We knew this when we purchased the project. We've spent the last 12 to 18 months replacing inverters, shoring up the trackers, making sure that everything is functioning properly. And that's why we will also see an uptick there. And some of these assets, namely Neo and Santa Rosa, Planeta Rica, Los Girasoles, so 4 out of the 5 will actually for the first time have a full operational year. So we're seeing a partially operational year result this year. In 2024, this will change. So even though we are not having any exact guidance now, we will share this early next year when the overall budgeting process is done. We can expect revenues to be significantly above $10 million. We can see margins return to the 70 to 75% range where they belong, so that we actually see good output. And paired with the measures that we've defined, which I will address later in the call, we should also on the corporate level see a much better performance next year.
So the general EBITDA margin we should use for your project, is that around 70? You know, I know there can be small differences, but that should be the starting point, the benchmark that you will try and reach, and then of course we can do our own math on the output and also with the rising PPA prices. So, but is that in general what we should expect from the size of projects you have?
Yeah, so 75% is the margin that I always use for the entire portfolio. The CHP plants, they are more between 60 and 65 in a normal year.
Okay, yeah.
We have some solar plants that are 80 or above. So it usually works out on average at around 75%. This is the value that I usually plan with, and that historically has proven to be quite accurate. Yes.
Perfect. Thank you.
I also want to briefly touch on our free cash position. Free cash is what we define as the money that we actually have freely available for project investments, for covering our overhead, like personnel expenses, administrative costs, and also development expenses for new projects. We are standing at the end of September at 8 million in free deployable cash. This does not yet factor in the 2.4 million that we will recover from the Añasco project in Puerto Rico, what I mentioned earlier. And this does also not yet factor in measures that we're taking to further increase the free cash position. Why am I focused on increasing the free cash? Because I think the interest rate environment is dramatically different than it was 1.5, 2 years ago, for all the different reasons that have been discussed in detail. And even though we have access to outside funding, equity and debt, doesn't mean that that funding is attractive in terms of the cost, the price tag on it. And we have certain expectations to the return that our projects need to bring, and we need to align those with the cost of external funding. If we shore up the free cash reserves, that provides us greater flexibility, because some of the money has been borrowed at, let's say, lower rates, if you will, and that's why it makes it much easier for us to pursue good projects that still meet our hurdle rates, but are maybe not 100% at the level where some of our investors would like them to see. So I'm sure we can invest at 15, 16% IRR on equity. 20% is a tough call. And I want to remain flexible, to be able to deploy money into development assets, to be able to cover any short-term needs, and also to make investment decisions in projects, and really good projects, without having to go through a lengthy process of raising capital. So this is why it's important that we really focus on this. Which brings me to the question of what do we actually want to adjust? What do we want to change? Priority number one is to create the maximum number of alternatives. The greater our cash reserves, the more flexible we are, the more short-term we can react. And this is why we left the Puerto Rico project, which is why we've stopped some other projects, and while we're still working on other measures like farm downs and other activities to continue to increase the free cash position, which is then something that ultimately should also immediately be reflected in the stock price. I mentioned the upsides next year, the optimization of the existing portfolio, making sure that the project cash flows that we can expect are balancing out the spending that we have on overhead and development expenses, at least. This can only be done if we consequently also reduce our cost structure as a whole. I will get to that in a minute. I truly believe that in the pipeline, in the value chain of our business as a full cycle IPP, it's developing projects, building projects, operating projects, that we need to put a greater focus on developing our own development backlog, greenfield projects ourselves, because this is where we can create the greatest value. If you acquire a project from a third-party developer, you will always have to pay a development fee. If we develop our own projects, then bring in co-investors, we can actually secure that development fee ourselves. And that is a significant boost to the returns, and thereby creates the greatest shareholder value. And if you look at our current portfolio, 2 of the projects were developed by third-party developers, and we came in at the beginning of construction. 1 of them we acquired operationally, and only 2 of them did we develop and build ourselves. And we see the difference in the returns and performance. So this is what we will put a greater focus on. We have a very strong, a big, a significant development backlog that I will show you on the next slide. And we believe focusing on this will ultimately be the right move for our company. I mentioned shoring up cash reserves. This is in part achieved by selectively farming down certain assets to return the cash, but also to, let's say, exit the projects that we no longer put a focus on, where we know that other developers or investors are more interested, and we can sell these. And I believe for all future investment decisions that we will make to grow our portfolio, we will bring in co-investors to at least take part of the development fee that we would ultimately collect off the table right away, thereby securing earnings and cash in, and also reducing our own requirements to contribute capital for new builds. Last but not least, very important, because we're not growing as quickly as we originally anticipated for all the reasons that we discussed over the last 2 years. We want to reduce our overhead spending. A significant part of that will already be achieved simply by one-off items that we faced this year, certain ramp-up costs for projects or costs for certain initiatives that we took on corporate level of around $1 million, that is fully reflected in our P&L as of today, that we will no longer see next year. On top of that, because we will have fewer projects to administer, to develop, we will bring down support costs from third parties significantly. That's several $100,000 that we can calculate with. And then depending on the investment decisions that we're taking, we may also have to look at our headcount. Certain people leaving the company may not have to be replaced, so that we are creating some redundancies on that front. We're trying to prevent that as always, because we need our team for future growth, but that does not mean that we cannot make or don't have to make short-term adjustments. So,
and Stefan, a little bit on this selective farm down, you write existing project, and I think that, is that operational assets, or is it something from your development pipeline that you are in some certain way with? How should we understand that? Is it taking some of your operational assets also and looking at farming that down, or is it just maybe something from your project pipeline that you could sell for even it's an early stage and maybe sell out that? So where should we look at this farm down?
It's a combination of both. We don't need to own our operational assets 100%, and we do so for the most part. So I believe bringing in a co-investor, taking some of the return and money off the table right away is certainly a good decision, especially if that investor is also interested in joining forces down the road. So you can bring them into the existing portfolio and you can secure a partnership down the road. And it also concerns our development backlog very clearly, for the simple reason that certain countries we no longer find as attractive as 2 years ago, namely Colombia, where we've seen a lot of challenges with our existing assets, Planeta Rica just being one of them. And we believe there's the greatest upside if we sell these projects rather than investing and developing them ourselves. So we are getting them to a stage where we believe we can secure some good value, and then we might farm them down. So it will cover both sides, but predominantly the development backlog. Selectively, we have some priorities that you see here: 6 projects in Guatemala, Panama, El Salvador, Jamaica. The rest are taking a back seat. And for the operational portfolio, it will depend on who can we bring in as a co-investor, and what is the strategic value of that partnership for the overall company.
And regarding that, I already in talks to some co-investors in these regions, and is it local players or is it US players in that region? I know you can't go deep into to project talks or sorry, negotiations, but I already in talks, and what type of investors could be a co-investor?
Yeah, so it depends on the country or the region, or the section of the region that we're in. In Colombia, we are predominantly seeing interest from strategic investors that are local players. In Central America and the Caribbean, it's more financial investors that believe they need to join forces with someone like us, developers, IPPs that have the knowledge, the market access, and they can provide the funding. And these are more international in nature.
Perfect.
All right, just based on what I said on what to expect, I mentioned all of these, going back here, all of these upsides. And based on all of this, 2024 will significantly outperform the 2023 numbers that we're expecting this year, for the simple reason that we will have more assets, and the challenges that we were facing this year, or the one-time impacts that we're facing, will no longer be relevant. So 2024 will be much better. I personally expect that 2024 will be the first year that we are also showing an operating profit on corporate level because of better project performance and at the same time lower costs on overhead. And that should provide actually a very nice profitable balance. And then just to highlight this, there's 2 projects in our development backlog at the moment where we will have to take the investment decision shortly. One is our very good project in Guatemala, which is doing very well in development, has already secured a construction permit and very attractive financing. We're talking to partners about a co-investment. This project will be ready to build early next year, latest. So we have to take the investment decision shortly. I'm not saying that we will invest, but I'm saying that this project is ticking all the right boxes at the moment and is very high on our list of priorities for future investments. And then the second one is the project Acacia in Jamaica. This is a project where a tender by the government has finally been announced. The market has been waiting for this for some years, actually. The bidding deadline is February, and we are really assessing every option, selling the project now, participating in a very competitive bid, selling it after, competing, staying invested with a partner. So nothing has been decided yet, but these 2 projects are the ones that we are looking at the closest when it comes to securing future growth for our portfolio. And that's all I have prepared, Michael.
Perfect. Yeah, but let's dig a little bit into what you said lately. And there's a question here, and I don't know whether you want to guide that precisely. Do you expect to reach positive EBIT next year with the changes you made and the expectations you're coming in? Will it be a positive EBIT? You mentioned that you will have positive EBITDA even with the operational, but will it also be positive on EBIT level?
It is possible, yes. I believe we have to distinguish. If we take EBITDA, so if we do the EBITDA after depreciation of the fixed assets, the answer is yes. If we also factor in amortization, which we do on intangible assets like development costs, like our purchase agreements that have been capitalized, it might be a bit more challenging because these amortization figures, which are non-cash, are actually quite significant for some projects. So I would say it's possible on an operating cash flow perspective, for which we believe in our business, EBITDA is the closest, let's say, fixed point. It's in my view, almost a certainty.
Perfect. And then there's a question here: will cash flow cover over the next 12 months also cover building costs if you decide to invest in some of the project that you have the fit decision on, or is that too much to ask? So it's this self-sustaining part, is that to cover your development cost and your cost of running the business, but not the building cost, or how should we understand this? How much can you self-finance through your cash flow?
Yeah, so the project cash flows are supposed to cover overhead and development expenses for now. Also for the simple reason that the timing of when these cash flows are flowing back to us is not 100% aligned with all the other spending that we have.
Okay.
And the free cash reserves is really what we will be tapping into to finance any new investments for now. Yeah.
Okay, yeah, and including potential co-investment also in
yeah, of course. And maybe this is a good point to elaborate on. Let's assume we have a project that requires equity of 20 million. We bring in a co-investor that is taking half of it, but that co-investor is also paying us a development fee. That naturally means we have to invest less than 50%, but we retain a 50% share. And that's really where a lot of upside is, and this is what we're trying to accomplish.
So there's a question here: should we understand that you will mainly focus on greenfields? That you have that is your main focus going forward. That will be, you might say, the MO of this company is that it is developing this pipeline projects, greenfield, and then looking for investors and co-investors. So that will be your main focus area going forward. You will not purchase anything in a later stage.
It is definitely my plan. I don't believe that purchasing ready-to-build or operational assets in the foreseeable future is what we do. We also want to, of course, expand our portfolio. So I cannot rule out all the options, but greenfield development and what you just described, developing, finding a co-investor, then building, is for me the MO, the DNA that this company should have down the road.
Okay. And then there's a question: how much is falling building costs covering rising interest cost in development projects? So to get a feel on how valuable are the projects still. Everybody is listening to a lot of negativity in the sun sector, but I know it's a special US segment. And I heard Nextera say that, hey, actually the falling building costs might actually cover the rising interest. So they would live up to expectations. I know you're not that size, but so a little bit of a feel on looking at a project. Rising interest will cause you cut into the IRR and the financing cost, but how much of that is actually covered by building costs maybe going down?
So I would say that especially the PV module prices have come down much more than I personally expected. We are seeing offers for new builds in Guatemala that are below $600,000 per megawatt peak, and we were talking about almost $1 million a year or year and a half ago. So that is a significant difference, and it clearly outweighs the rise in interest rates. And we see this in the Guatemala project, where, of course, the SOFR is the base rate, and that is standing at 5.5%, depending on which time frame you're looking at.
Yeah.
But the margin is 250 basis points, so you can still comfortably finance a project in the single-digit interest rates in some of these countries, and you're still benefiting from the capex coming down. So I would say that overall, we're currently in a situation where the rise in interest rates, while it has increased return expectations, does not mean that we cannot meet those. We can meet those because capex are coming down. So an investment is not a no-go. That is very, very clear.
Yeah, but I think that was all the question we had. Thank you to you, Stefan, for taking us through a more thorough this time, but also with a lot of changes that has been done since you took over the helm. So thank you for that. Thank you for the people listening in, and thank you for the questions. And may everybody have a nice day.
Thank you. There's more to come. Thanks, Michael.
Perfect.